Hello and welcome to Commodity Champions. I'm Manisha Gupta. 2022 has been a volatile year for the energy space. Crude prices have swung 10 to 12% on a weekly basis through the year due to the Russia-Ukraine war. Natural gas prices have also risen over 28% in this year, with major parts of Europe looking at a harsh winter. The gas prices are expected to stay on the higher side going forward too. The first half of 2023 also looks choppy for the crude market as Russia plans to cut output by 5 to 7% as a response to the price cap by G7 nations. Large U.S. refineries have shut down in Texas and North Dakota due to cold climates. This can also have adverse effect on the supply side. But will crude prices hit $100, $110 a barrel next year? Will overall demand and supply be majorly impacted in 2023? To answer all of those questions, I am now joined by Jeff Brown, who's president at FGE. Dr. Brown, hi, thank you so much for joining us. And what a year 2022 has been. We have seen volatility by 10 to 12% on a weekly basis. As we get into 2023, I'm assuming that much of that volatility, uncertainties is something that we will carry forward in this year as well. How do you look back at 2022? What do you think has mattered the most to the energy sector?
Obviously, Russia. I mean, we saw it from the start of the year when things kicked off there, and we've seen the extreme volatility. So Russia was probably the first half of the year, the huge story. And then as we got in the second half of the year, the global economy really started to weigh. And as you correctly point out, every day, whenever we saw updates to news, oil prices would react in a big way.
Oh, well, yes. While Russia-Ukraine clearly had a lot of role to play, Dr. Brown, as we step into 2023, apart from all of this still continuing, it is interest rate hikes and concerns about recession and inflation also weighing in. Would you say that macro is going to be a big part to watch out for as well in the new year?
Yeah, well, demand is the big story now. And actually, we still see pretty good demand growth next year, about 1.7 million barrels a day. And really the key here is this battle that's going on right now, and it continues to go on between expectations for the economy. And we all know, we see it every day on your program in terms of that there's a lot of warning signals, there's a lot of concerns out there. And the data continues to come in quite weak. But on the other side, we have the potential for COVID recovery. And COVID can be big, right? We're still down, China's down about 1 million barrels a day in terms of demand, where they could be if as they start to come out of this COVID related issues. We also see jet fuel way down. So when we look to the next year coming, those will be the two big stories on the demand side. The other thing we have to watch is Russia. So far, Russia has been sort of a non-event in terms of it keeps getting oil into the market. We expect it to be similar next year, but there's always the potential for disruption. So when you put these back, those are the key things we're watching.
You spoke about demand and the expectations on demand. You also mentioned 1.7 million barrels per day of growth expected in the 2023. But what about the supplies? Russia is clearly one part of it, but with the U.S. supplies rising and the OPEC and allies also looking to curb supplies, do you think they will step in? And what's your expectation with all of these major suppliers now?
No, that's exactly the thing to be watching. As you hit on the head, we basically expect demand and supply outside of OPEC to roughly grow together next year. The big issue will be what price OPEC wants. OPEC's spare capacity is still very low. It really leaves OPEC, and really when we say OPEC, Saudi Arabia especially, because they're the ones, them and the UAE have most of the spare capacity. So it really depends on what price they want. It seemed they had want higher prices before, but with the global economy slowing down, they're signaling increasingly that they're happy around this $80 type level. I would fully expect, though, if prices start to drop down towards 70, which could happen, especially over the next couple months as China is going through these difficulties with COVID right now, that they would step in and look to act. So OPEC, a lot of challenges, but basically OPEC's still in the driver's seat. So we need to think about floors for oil price around 70 is still as long as they still have this ability to act.
All right. So a possibility that the crude oil prices can decline to $70 per barrel in coming months. Well, that's about crude. But Dr. Brown, the other big challenge clearly is the gas prices, or the gas demand for that matter. Supply rather, because while we have seen Europe and other countries stock up quite well for these winters, with the European Union gas prices capped to see a launch on 15th of Feb, how are the winter months until March looking forward to you?
Yeah, gas is obviously very different than oil in the sense that while Russia's been getting its oil out and seems to want to get its oil out into the market, it's very much different in gas. It's just essentially cut off Europe, right? As we know, the gas supplies are about 10% of what they were before Russia-Ukraine. It's nothing's really going to change materially. We've seen prices come down recently in Europe to about $30 per million BTU. Still very, very, very high historically. That's partly due to the job that Europe has done in terms of containing its demand. But the supply is simply not there. Everyone says, well, why doesn't Europe buy more LNG? Well, there's not a lot of new supply coming in. It's very expensive. So basically, Europe and Asia will continue to battle over LNG all the way until we have new supply coming, which is more like 2025, 26. So for gas, the story is very clearly, because there's nothing coming along for the next few years, gas prices have to stay high.
All right, so a range-bound trend coming in for this one, but I also want to talk about the incremental demand growth. For now, for some years now, we have been saying that much of that demand has been coming in from Asia, China and India. China, of course, has been a bigger part with that. What's happening now with China slowing down? Do you think focus would have shifted to India now? And what kind of growth are we expecting from here?
Asia is a little bit unique that it buys about 80% of its LNG on sort of long-term contracts that are linked to oil and about 20% spot. And what we've seen is that all that spot buying has just dried up in Asia because prices have been so high. So Chinese demand has dropped. In India, demand in terms of buying spot-related LNG is also down as well. So Asia's had to make room through dropping its demand to get that LNG sent into Europe. We think Asia will come back in 2023, and partly due to long-term contracts starting. So Asia demand will continue to grow, and the long-term demand story for gas in Asia is extremely strong through the 2020s. But you know, it's really looking at the long term, as you say, the demand story is very much there for China, for India, for all three, for large parts of Asia. But in the near term, it's got to compete with Europe.
All right. Also, how much are you concerned about a slowdown or a mild recession in 2023 that almost everybody seems to be talking about right now? And if that is the case, what is its impact on the overall crude oil prices and demand that you foresee?
Well, if a typical recession, you'd lose. I mean, there's other things going on in the background, but you'd drop about 1 million, 2 million barrels a day of demand. So that very much would put a lot of pressure on OPEC. We could definitely see, if we start to see, you know, a good sized recession come in, we could easily see prices drop down into the, you know, $50 range, $50 or $60 range. And the pressure would really be on OPEC then, because then they'd have to do meaningful cuts. We're talking 1 million, 2 million barrel a day cuts again. So very much it's something we're watching. We don't have it in sort of our, you know, our base case, how we look at the market. We have it about a 30-40% chance, probability, I should say. And so that's how we think about it, but it's something that's very much on the radar screen.
Oh, well, yes, there's a lot of base cases that we are making right now. See case scenarios as well on what really could happen in 2023. But you mentioned a broad range of prices, Dr. Brown. If you're looking at 2023 and beyond, we've done the highs in this year, would you say, for the crude oil prices for the next couple of years? Or do you see the crude prices coming back to 100, 110, 120 kind of levels yet again? What is the range that you're working with for the next year now?
We don't see it going back to those ranges, barring any sort of disruption out of Russia. Okay, I should say major disruption out of Russia. And we don't see a major disruption coming. So far, there hasn't been. So far, those who've said there's going to be a big disruption have been wrong. We expect that Russia will sort of move along sideways in terms of production. So we don't expect prices to go back up into that $110, $120 range. We think that over the next couple months, there's more risk to the downside in terms of price from where we are. Again, tracing back partly to China opening for COVID. And then as we move into the second half of 23, we'd see prices moving back up toward above $80 a barrel.
All right, so thereabouts $80 a barrel is what you can see in crude. Dr. Brown, also, what's your sense on the gas prices going forward? I mean, you said you expect them to be in a range, but what kind of range?
Gas prices in Europe, we need to plan on around $30 per million BTU. Now, there's going to be seasonal swings. Gas is always highly seasonal, but we need to plan at about $30.
Okay. A final word before we wind up this conversation on the rate hikes from the central banks, the impact of the US dollar index on commodities as well, and also on the speculative trade, because we've seen that move the markets quite a bit. Volumes have seen a bit of a decline. From where we are standing right now, how do you look at the beginning of the next year?
Yeah, I mean, you hit it on the head. I mean, obviously, US dollar is very important, especially for oil. We see that close correlation. Right now, that we know it's driven by U.S. Fed. The market seems to expect the U.S. Fed to tighten, to increase rates up to around 5% the first part of the year. Internally, we think it could even go higher than that from the various people that we work with in that space. So that's probably where we would see the risk lying. And obviously, that would be can be more bearish for oil.
All right, we take that point very well. Dr. Brown, thank you so much for joining us and talking to on CNBC-TV18. With that, let's head into a short break. Up next, Vikram Dhawan, Head of Commodities and Fund Manager at Nippon India Mutual Fund, joins us on the discussion of performance of gold in the previous year, outlook for the next year, and how does gold behave within asset classes and how does it work for your portfolio. All of that after this.